Hello, this program is going to be about money and banking. It's a subject I think that a lot more people are interested in since the financial crash in 2008 and the banking bailouts. And most people probably don't know too much about money and banking. It's quite a complex field. It's one that really does demand some serious amount of scholarly reading. And therefore most of us, I don't think, take much interest in it. We just want to be able to use money each day for our transactions, and that's pretty much it. But when these problems occur and when the repercussions are huge for society, then of course we start to take a bit of interest, and there's been quite a few programs made about the problems in the financial sector. There's even been a few movies, some sort of cult films, and there's quite a lot of woo spoken about money and finance, and all sorts of rumours that people spread that frankly are nonsense. So in this program I thought I would take a sort of philosophical and principled look at the issues and hopefully come up with something that is clear and leaves you understanding what's going on. So please do keep listening. This is a sort of a slideshow format, so I'll just be talking over slides. So here are some of the questions that I'd like to address in this program. We're going through a bit of a sort of a historical thing to find out what money is and how it arose. I'm also going to be explaining exactly what money does, hopefully in a meaningful and real way. And we'll take a look at why we have banks. And then towards the end of the program I'll be talking about some of the serious economic and social problems associated with the money system. We should be answering this question of, is it actually money that's a problem? And of course there's quite a few people who think that it's actually immoral to make money by lending money. This is an old religious fiction, at least I think it is, and I'll be talking about why I think that is. And we'll be taking a look at some of the concerns around fractional reserve banking. Is that a wrong thing to do? And just sort of one on the end there, should banking be nationalised? With a lot of the issues that have occurred recently over bank bailouts and so on and so forth, people are looking at the huge fortunes that bankers make and saying, well, hey, we should nationalise banks, and then these people won't be able to profit from all the banking malpractice. And then finally I'll be looking at cryptographic currencies such as Bitcoin. Let's wind the clock back then to the sort of prehistory, pre-money period of human development. So bartering nomads would have had a very limited ability to be productive because they were moving around all the time. Their tools were primitive, and they couldn't really do much in terms of trade either. If you imagine that you're living in this group of, 50 to maybe 100 people, you know most of the people by face and by name. So your ability to trade with them is very limited because you can only produce a few things, and once you've produced a few things and given them to a few people, you pretty much saturated your market. So the ability to accumulate wealth in these prehistoric, very early historic periods was exceedingly limited. Perhaps you could have a few extra horses, or a few extra necklaces, or a spare dagger, or whatever primitive tools you could produce. Advanced technology is also impossible in this mode of life. So you have things like high infant mortality and death in childbirth being quite common, and then you have risk of hunger or starvation. So you have this real struggle against nature. And this means that there has to be a great need for trust and cooperation between individuals in the group. So one of the things you might do to foster trust and cooperation is to be helpful to other people by giving them extra food if you gather it, and just being generous to others, so that if you find yourself in need of trusting somebody else, perhaps you have a difficult encounter, an injury or something like that, you need to be able to hope that other people will help you. And so the best way of doing that is to help other people. Now, within the tribal system, where you have just a small group of people who you can know by face and name, you can kind of keep your own internal ledger of who you've given extras to, who you've helped out, and then you can see if those people help you back. So this ledger concept is present in these societies, and it's just that it's done very personally in the head. And of course you can only cope with remembering sort of around 50 faces or whatever, so it's quite limited, but it does guarantee that things remain fair within the group. So there's a sort of kind of natural ability to maintain fairness within the group around bartering and around helping each other out. So really you don't need money when you are just having a trade situation between very few people. Now, of course, bartering is very problematic for quite a few reasons. For example, if you happen to be particularly good at making, let's say, daggers, flint daggers or something like that, then once you've made flint daggers for everybody, you can't gain any benefit by making any more, because you've saturated the market. And you could also have problems with exchange. For example, one person might have a extra horse that they could spare, and another person may have a spare dagger, but you find that those people can't trade because the horse is just worth so much more than the dagger, and obviously you can't just sort of cut the horse in half or give away an ear or something like that. So barter is very limited. Liquidity is pretty much non-existent because of the problems I've just suggested. So really there's not much ability to develop and accumulate wealth, taking into account all these factors. So just to conclude this part on the bartering nomads, it's important to understand that they don't need money because you can keep this internal ledger of who you've given favour to and who's given you favour in your own head, and also you can rely on those people still being around, hopefully in the near future, to return the favours. So at different times and in various different places, humans began to develop agriculture, and with that came settlements, specialisation of labour, and eventually once agriculture had become dependable enough and productive enough, you had surplus production. Coupled with this, there was also technological development, and the results of all these improvements in human living conditions eventually were reduced infant mortality and thus population growth. And it's at this time in early recorded history that we also see the inception of markets. So you have this surplus produce, you want to do something with it because perhaps it's grains and it's going to go bad after a certain time, or you've just got more than you can foreseeably use for the next year or two. So you've got some excess and you can give it to somebody else, or you can trade it with somebody else. So people come together. Some people have got excess grain, some people have got excess, coats, cloth, shoes, and what have you. So these markets begin to develop. One of the problems, again, with barter, as you remember from the horse and the sort of flint dagger example, is that you have this problem of not being able to reduce things or convert things at the market, perhaps with the person that you want to trade with. So you might want shoes and have excess grain, but you can't trade because the person selling the shoes doesn't want any more grain. So you have to work through an intermediary or a set of intermediary parties, finding somebody that wants your product and getting something that somebody else wants. And so you can do this at a market, and what happens is you have raised liquidity. You're more able to dispose of your surplus wealth and acquire something else that you want in exchange for it. Still, at this point, with just bartering from one to another, it's a rather limited market, and it probably isn't much sense in making a great deal of wealth. Perhaps you can't store it. If it's grains, it goes off, and so on and so forth. So at some point, the ability to use commodities of exchange arises. These are called currencies. They're any commonly accepted goods that are used rather than for an end purpose, purely for the exchange. And typical things that were early currencies were grain and gold. Now, of course, grains do spoil, so have a limited shelf life. On the other hand, gold, of course, lasts forever. So these currencies would have started to be used in markets. There might have been tea. I mean, anything really that most people are interested in using and come to accept can be used as currencies. Now, the problems, as I've said before, you get spoilage with grains. You can get debasement, even with gold. You can be mixing other metals in. You could get some kinds of fraud as well because of that. And another big problem with these kind of consumable currencies like grains, and to a lesser extent, much lesser extent with gold, is supply fluctuations. So if everyone starts to trade, let's say, in grains as the currency, and then there's a sort of a famine, all of a sudden your ability to sell your surplus produce is greatly diminished because of the lack of supply of grains to trade with. So everyone kind of becomes dependent for their trade and exchange on the currency availability. So this limits liquidity, and of course markets have a high transaction cost. You have to pick up all your stuff and take it somewhere else to sell, and this is not always practical. It's not always easy. It's expensive to do that, so it means that things like cheap or low cost items simply may not be efficient to market. But even so, the market economies flourished and wealth started to accumulate, and with that comes the risk of theft. So once people have started to accumulate a lot of wealth, they're wanting to put it somewhere safe, and so we have the development of early banking. Now, the earliest forms of banks were actually temples, typically controlled by the rulers, and invariably banks were involved also in tax collection, or theft, if you prefer to call it that. Early banks basically allow very wealthy people to deposit their assets securely in the king or whatever they were, whatever ruler they were, to put them in their temples, and a ledger would be kept at the temple. They might even receive interest, and should the person depositing the wealth fall into difficult times, then the ruler would allow them to withdraw some of their grain or their golds or whatever it is that they'd put in. Now, basically this business practice was limited by a central authority. It's the ruler, it's the high priests or whatever. So you're kind of at the mercy of these people. And this is a bit risky because, of course, rulers had a bit of a thing of being greedy or going crazy. They like to start wars, or they like to fritter money away on themselves. So it was a risky business, this early banking. And what began to happen eventually in the world is the Abrahamic religions started to spread. Christian, Judaism, these actually restricted interest. Islam kind of abolishes it altogether, although there are sort of ways of kind of getting around it. So this thing of paying interest kind of disappeared for a long time, and it really stifled economic development. Because you imagine in the early days you were a farmer producing excessive grain, well you could take that and you could put it in the temple and give it to the ruler, and then the ruler would lend that out to people who had just acquired land, and they would plant the seed, they would grow lots of new grains, and then they would repay their crop, some of their crop back into the temple. And then, of course, all the people who deposited would possibly be given interest, and of course the ruler would get wealthier as well. So it's kind of good all around, basically, this lending of surplus wealth to other people, and it helped economies to develop.